Imagine you bought a lottery ticket that turned into a golden trophy, then the trophy developed a loose screw and the sponsor replaced the lock. The crowd gasped, then shrugged. That's Super Microcomputer, SMCI. Lately, huge upside from the AI server boom, then a sequence of earnings misses, downgrades, and weakening fundamentals that have more than a few investors reaching for a more cautious sip of coffee. In short, analysts have downgraded SMCI to hold after repeated earnings disappointments and signs that the AI gravy train might not make the company untouchable. SMCI is trading around $30 to $32 per share, the user quoted $31.66. That's roughly 30% below levels from late September, and the stock has found a stubborn patch of support at this level, which is why many holders aren't trimming their positions despite the downgrade. The psychology is simple: the price has already taken a painful haircut, and buyers who missed earlier runs don't want to sell at the same discount they once regretted buying at. Here's the blunt part: Super Micro just recorded a second consecutive quarter where both revenue and EPS missed, a dual miss, and that marked the seventh straight quarter without a dual beat, i.e., both revenue and EPS beating expectations simultaneously. That's not the kind of consistency investors want from a hardware company that's supposed to be riding an AI tailwind. Repeated misses often force analysts to trim earnings estimates and re-rate the business, which is exactly what we've seen. Let's put some context around the ticker. Super Micro is about a $19 billion market cap company with $21 billion in trailing revenue. Figures change slightly by source and timing, and the share price cited sits around $31.32. That's not a microcap hobby. This is a full-grown enterprise with scale, supply chain complexity, and large customer relationships. Investors should treat it like an industrial technology company with server cycles, not a high-flying software startup. The fundamentals matter. Over the last 12 months, revenue growth was roughly 11.9%, while operating margin sits in the low single digits, 4.4%. Those numbers are fine for a steady industrial company, but they aren't what you'd expect if you believed the AI hardware market would hand Super Micro significant, cleanly profitable share growth. Low operating margins combined with intense competition tend to mean either you win on volume and scale, or you win on higher margin value-add services. Super Micro's current profile doesn't scream either. On liquidity, Super Micro's debt-to-equity is very low, and cash-to-assets around 0.29. In plain English, the balance sheet has liquidity and isn't heavily levered. That matters because a healthy balance sheet can buy time for restructuring, R&D, or a push into services. But a tidy balance sheet is not a get-out-of-bad-execution-free card. The market will still punish poor forward profitability or persistent misses in guidance. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Valuation looks like a compromise between growth expectations and risk, a P/E around the mid-30s and P/EBIT roughly 28.9. Those multiples imply the market still expects growth and recovery, not full-on terminal value compression. If fundamentals keep slipping, lower margins, weaker guidance, the multiple will likely re-rate lower, and that's the fear driving the upgrade/downgrade dance you're seeing. The pullback pattern: why many investors don't trim. Why people don't sell into weakness. Behavioral finance and market structure give us the answer. Many have been burned at lower prices or missed the 2023 to 2024 rally and now have a disposition to hold. There's also technical support at current price ranges. Momentum players sometimes step in at round numbers, low to mid $30, and institutional holders often need time to rotate. That creates a soft landing floor for the stock, at least temporarily. But floors aren't foundations. They can hold until new news, guidance, analyst downgrades, macro shocks, breaks them. The median plus 30.9% argument, a trap or a trove? An interesting chart statistic floating around is that after sharp declines, SMCI has delivered a median return of 30.9% within 1 year historically, since 2010. That's the classic buy the dip data point. Historically, big declines were followed by meaningful rebounds. But be careful, historical median returns don't guarantee future performance, especially when the underlying business and competitive landscape change. It's tempting to treat that number like a comfort blanket, but remember, the world in which SMCI rebounded previously may not be the world today, different competitors, margin pressures, and prior governance issues. Use the 30.9% stat as context, not as a trading rule. Picture a bustling bakery that got famous for a new high-demand croissant recipe. Sales exploded, people queued around the block. Then a new health craze hits, gluten-free, and the bakery's competitors start offering cheaper, equally tasty options. Some even sell subscription dough plans. The bakery still makes great croissants, but now fewer customers are willing to pay a premium. The bakery has cash in the bank, low debt, but its margins drop because it has to discount and invest in new machinery. Owning SMCI is a bit like holding that bakery. Product is great, but the market is changing, margins are under pressure, and investors are asking whether the bakery can keep charging the old prices. Why analysts lower ratings? The downgrade to hold. Analysts downgrade to hold when the risk-reward tightens, when downside is less attractive and upside is no longer obvious. For SMCI, the mix of repeated earnings misses, stagnant or compressing margins, and ongoing competition from the likes of HPE and Dell, which can bundle services and financing with hardware, made the hold call reasonable. Holding means, we like parts of the story, but we don't want to be aggressively long right now. 3 scenarios for SMCI's next 12 months. Base case, cautious recovery, most probable. The company stabilizes gross margins, no more large sequential compressions, and beats the next few quarters narrowly. Orders from hyperscalers become lumpy but intact. Inventory digestion continues. Stock drifts slowly upward, 10% to 40% potential upside depending on multiples re-rating. This is the scenario where hold is the right rating, steady, unspectacular, manageable risk. Bear case, structural squeeze, pains persist. Continued dual misses, further downward revisions, margin deterioration due to price competition and rising component costs. Customers shift to integrated players, Dell, HPE, and SMCI's share of AI OEM orders drops. Stock falls materially, downside of 30% plus possible from current levels. Bull case, reacceleration, less likely without evidence. SMCI wins a string of large deals, demonstrates margin expansion, via higher ASPs or services, and demonstrates supply advantage with NVIDIA GPUs or similar. Governance concerns remain settled and investor confidence returns. Stock re-rates meaningfully, 50% plus upside. Assess probabilities accordingly. Most pros grade SMCI closer to the base/bear mix today. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this, I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.